we start to trade right now, we have the Nifty, which is down by 111 points below that 25,600 mark, closer to 25,900. The broader market bleeds too. The rupee hits a fresh all-time low, crossing 91 to a dollar.
FMCG stocks hold up as the sole sectorial gainer. Britannia too gains as it appoints the new CEO for its dairy business.
Fertilizer stocks, they surge following the finance minister's comments stating that demand for fertilizers remains strong and that the government must provide funds for any additional requirement.
Motilal Oswal issues a buy rating on Arvind Fashions with a target price of 725 rupees a share. The stock is the big outperformer from the broader markets, up close to 4%.
Another one which is an outperformer is DMart, up 2.5% after CLSA issues a high conviction outperform rating with a target of 6,300 rupees a share, expecting strong free cash flow going ahead.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as we can see, the market currently trading in the red. We're still defending the 25,900 odd mark, Mangalam. But individual stocks are doing a thing of their own.
Individual stocks are doing a thing of their own, Nigel. You goaded me the last time I wore this and you said that it's not matching the market.
Yeah.
Turns out that it's matching the market.
Today's market.
If it does happen that way, then maybe one day we'll wear a green shirt as well and see whether it matches or not.
Shoes.
Well, be that as it may, a lot of individual stocks buzzing around. None bigger than Meesho. What a big move that we're seeing on that stock. And the other side, on the other side, we're also seeing a bunch of these, brokerage notes impacting movements. We've seen moves coming in on names like Arvind Fashion as well as DMart. We'll watch out for a few other stocks as well as we speak. We do have, Astral, which is taken a bit of an up move right now. Varun Beverages is the other one which is seeing some bit of an up move. Remember, Varun Beverages seasonally, this is not a very strong quarter for them for their India business. But a couple of years ago, they went ahead and acquired business in Africa, which deseasonalizes a lot of their business. So, which makes this quarter look extremely good as well. But we have the insurance stocks on our radar. We'll probably try and get Yash shortly on that as well, because Insurance Laws Amendment Bill, which received the Union Cabinet's nod on Friday, will be introduced in the Lok Sabha today. It allows 100% FDI in the sector and other key amendments as well. We'll go across to Yash Jain in just a bit on account of that. But before we do that, let's talk about new listing. We have magnet winding wire manufacturer KSH International's 710 crore rupee IPO, which is open for subscription. All right, we will have to wait for Yash, I'm told. But we'll try and get Yash. What we'll actually do is just take a short break, come back, we focus on the Insurance Amendment Bill, and we get chatting with the management of KSH, the IPO that hits the bourses right now. Take that break, come back. Welcome back. It's down about 120 points for the Nifty. The mid-caps down by about two-thirds of a percent. The Nifty Bank down by about 0.5% as well. But the big story is the Insurance Amendment Bill. And as we speak about that, it has been tabled. What are the key proposals? What the outlook for the sector is and what the impact it could have on individual stocks as well as the sector at large. We do have Yash with us in the studio. Yash, take us up.
Well, Mangalam, it's been a 4 years wait, right? After it was first introduced, the amendments, and finally getting tabled today. And multiple changes came through in those 4 years. Finally, some very big reforms being tabled in front of the Parliament today. I'll first take our viewers through those key reforms which have been tabled in front of the Parliament. The first and the biggest decision, 100% FDI allowance as far as insurance sector is concerned, and this would be done through an automatic route, which means no regulatory approval will be required, no government approval will be required for a foreign entity, which could include foreign portfolio investors, to have a 100% owned insurance unit in the country. As far as the details under this are concerned, they'll be very crucial. What kind of board seats are given to Indian origin people? The second one, the Insurance Amendment Bill to allow merger of insurance companies into non-insurance companies. This has been a very controversial issue, specifically with respect to one company, the listed one, Max Financial Services, which has been trying, for the purpose of simplification of corporate structure, to merge Max Life Insurance Company, which is the unlisted life insurance unit, into the listed entity, which is Max Financial Services. But so far, Section 35 of the Insurance Act wasn't allowing that, and now it has been allowed as far as that merger itself is concerned. So big positive for Max Financial Services here. The third one, open architecture for individual agents, that particular element has been dropped, which means essentially agents won't be allowed to tie up with more than one life insurance company, one general and one health insurance company. They will continue to operate only with one of each category of businesses.
We will take that on board, Yash, but we do have a guest with us as well. Amit Jingran, who is from SBI Life, joins us. It's a big CNBC TV18 exclusive. So, Mr. Jingran, your first thoughts on the insurance amendment bill. What are the positives? What could have been better, according to you?
So the 100% FDI was the most anticipated thing, as the Honorable FM had already covered it in her budget speech. This will attract long-term capital to the country and also lead to technical upgradation, more innovation. And looking at the penetration level in India and the insurance density, I am sure that this will open up market further and will be good for the customer segment as a whole.
Mr. Jingran, I want to come to you with a point which was closest to SBI Life out of all the amendments which have been tabled, and that was the whole idea on open architecture for individual agents. 28% of your new business premium comes through individual agents, and there was a risk that if these agents are allowed to tie up with more life insurance companies, there could be a risk of higher cost for you or losing out on business. That seems to have been averted. That seems to have been dropped. How big of a relief do you think would this be for business? What could have been the risk if this would have come through?
So all the provisions of Insurance Acts are as dear to us as an industry player. And regarding open architecture in agency, I will say that this step will create more number of people to take agency and will increase the employment potential for everybody.
Okay, 28% is where it currently stands as contribution to your company. Do you think now with this overhang being averted, do you think the share of individual agents in your new business premium would go higher? Because that generally entails a lower cost as compared to banca. Do you think that could now go higher as you would focus more on individual agents?
So we have been trying to improve our agency contribution to total business mix for last 2 years, and we have seen positive movement in this product mix in last 2 years also. And I'm sure that this focus of company for improvement in distribution mix will continue in coming years.
Okay, one question, Mr. Jingran, as far as composite insurance license is concerned, that has not come through. Of course, this was a revolutionary move, it would have come through, but doesn't seem to find a place. Where do you stand on this argument? Is it positive? Is it negative? Do you think this could have increased penetration and we've missed a chance here? The government has missed a chance to introduce composite insurance license?
As a company, as a subsidiary company of a bigger group which also has a general insurance subsidiary, this particular thing was not on our radar. So as a company, it doesn't affect us at all.
Okay. Mr. Jingran, there have been various steps which have been taken to bring new players in. Of course, the biggest one is 100% FDI with new large players coming in. The net worth requirements have been reduced to bring smaller and niche players into the industry as well. I mean, considering the largest private life insurance company with a large market share, do you think somewhere 4 years, 5 years down the line, it could create, more intense competition in the industry for a player who's been commanding a leading position and could lead to, some sort of loss of market share for you as well?
As I said in my opening remarks, the kind of insurance penetration that we have in India and the insurance density that there is, the pie is so big that more number of players coming in will further open up market. As you yourself said, there may be players who will like to cater to niche segment and all. And I am sure that expanding market will definitely be good for the industry as a whole.
Mr. Jingran, one more point as far as investment regulations are concerned. Authority has been given empowering the regulator. How? I will tell you. For life insurance companies, about 50% has been allotted when it comes to central government and state and central government securities, and the balance 50% of investment the authority has been given to IRDAI, which could make the regulations. Now, in all scenarios, one could imagine that insurance companies might ask for higher investment allowance when it comes to an asset class like equity to increase the returns for their policyholders. How big of a positive could this be for a company like SBI Life? And how could the investment scenario change with this change coming through?
There are there are so many areas where the IRDA has been given more power, and we will be studying the provisions in detail in coming time, and will interact with the regulator for on all of these things.
Mr. Jingran, just one final question as I let you go. There is one important provision which the government tables, and that is giving IRDAI the powers to cap commissions, to cap remuneration, and to cap rewards. One more adjoining thing with this thing is that insurance companies will have to submit details of expenses of management. How important would this be from a transparency point of view? You know, giving, furnishing details, everything, how an insurance company spends, every little detail about it.
The regulator, IRDA, was already looking into the expenses of management, and the regulation about this had been changed around a couple of years back. I am sure that this step will bring more transparency and will create a better regulatory environment for orderly growth of the industry.
Thank you, Mr. Jingran, for that very important conversation. Mangalam and Nigel, it's back to you.
Thank you.
Right. Thanks a lot, Yash, for taking us through that conversation as well. We'll obviously keep playing bits of this important conversation, the big CNBC-TV18 exclusive. The first time we got SBI Life immediately as we got what is likely to be on, the bill that will be tabled today, the Insurance Amendment Bill. So that is CNBC-TV18 for you. Big, exclusive, and always in depth. We'll take a short break, come back and get you KSH International 710 crore rupee IPO that is open for subscription. Rajesh Hegre, the managing director, joins in on the other side.
Welcome back. You're tuned into Chartbusters here on CNBC TV18. Well, as promised, let's focus on magnet winding wire manufacturer KSH International. Their 710 crore rupee issue opens up for subscription. The IPO, has two variables. One is the fresh issue of around 420 crores and the offer for sale of around 290 crores. We're joined by Mr. Hegde, the managing director at KSH International, who joins us on the show. Hi, sir. Good morning and welcome to the stock market. All the best with regard to the IPO, and we look forward to interacting with you. Now, one of the prime reasons that you're raising this money, the fresh issue, is to repay some debt. So give us a few details. What would the debt number look like post this issue? Are you repaying everything? And what would the interest savings be? So we could get that out of the way first.
Okay. So in terms of the debt journey, what I wanted to tell you is that we had raised about 176 crores of long-term debt about 2 years ago for this new project which we are setting up in Supa. And this 420 crores of primary that we are raising, 225 crores of debt we would be repaying. This is both long-term as well as short-term. And overall, as of October, we had about 520 crores of total debt. And that would be reduced to by about 226 crores.
Got it.
And overall, the debt equity ratio would, eventually be about 0.83.
So your basically debt comes down to around 300 crores ballpark, right?
Yeah, approximately.
And approximately that would be an interest saving of around 22 to 25 crores?
Yeah, you could say that. Also.
That's important because, your quarterly profit is about 22 to 25 crores. If you adjust that for tax...
I would say it would, on a yearly basis, it would bring down the interest by about 15 to 17 crores. 15
to 17 crores, and that obviously aids your profit by about 10 to 12% as well. Importantly, I wanted to know a couple of things. Leading up to IPOs, companies do phenomenal revenue growth. They show margin expansions. And you've done both of that. 30% plus revenue CAGR from the time you've been reporting for the IPO. 1,000 crores has turned into about 1,900 crores. The first quarter this year, you've done about 560 crores on the top line. And all of this with sharp expansion in the margins as well. 4.7% turned into about 7%. The question is, this is great up to the IPO. post that, how sustainable is this 30% revenue growth, and at what levels do margins peak out?
Yeah. So just so that you understand our business, actually, I mean, we are basically, the right way to look at this business is on a unit economics basis. That is EBITDA per ton, because one of our key components of our cost is actually copper. And copper, we are in a B2B business and a make-to-order business. And in our business, copper is generally a pass-through for us, 100% pass-through. So what happens is, some years copper could go up, or some years copper could go down. But as we focus on the value addition. And if you look at the EBITDA per ton, on a unit economics basis, then over the last 3 years, if you see, there has been a significant expansion of the EBITDA per ton. And going forward, we feel that this EBITDA per ton, where we are at currently, that is sustainable because of the increase in capacity that we have done. Of the 30,000 tons of additional capacity that we are adding,
Yes.
12,000 tons is already operational as of 1st of October.
Right.
And the balance 18,000 will come over the next, by Q4 of FY27.
Just to get that EBITDA per ton, sir, out of the way, how much is it?
So as of the June quarter, it's about 65,000 rupees, per metric ton.
Okay, 65,000 rupees per metric ton. And if you could give us a difference between domestic as well as exports, because I can see your exports percentage has gradually been coming down. So in terms of profitability, is there a variance over there?
Exports are generally more profitable than local.
Okay.
But if you see, historically, we've maintained about 30 to 40% of export versus local mix. And we've always maintained a 20, even if you see our number today, it's about a 20% CAGR in terms of export volume. Last year or the last 2 years, we shifted our focus more to the local market to focus on the higher margin 765 kV transformer segments and some of the higher margin segments and higher value added segments. And we didn't want to leave the Indian market, but the endeavor is, of course, going forward, we would look at maintaining between 30 to 40% in terms of exports.
All right, 30 to 40% in terms of exports. Just a quick couple of questions. One, your current overall capacity is what, including the capex that there is?
So currently, as of 1st of October, it's about 41,000 and 41,000 metric tons. Yeah.
Because what we're trying to understand is what could your peak EBITDA be at around 65,000? It's close to around 270 crores. That would be a fair estimate, right?
A little bit less than that, I think, yeah.
But can you go to 100% in a business like yours? Or
no, it's normally about 80-85% is the more sustainable capacity.
So that makes about 230, 240 crores in terms of an EBITDA. And the reason why it matters is because, you are offered at an implied market cap of close to around 2,600 crores, add a little bit of net debt as well. So you would roughly be around 10.5 times EV to EBITDA on a forward basis. So that's just to clear the air on the valuation bit. Just a final bit that we want to know from you, working capital days, because of the export prevalence, it's around 72 to 80. Is there any scope for improvement there, or is it likely to stay this way?
No, we are working on certain improvements, because as we scale up, then we would look at reducing the payables day actually with our current copper suppliers, and that would definitely bring down the overall working capital days.
To what?
Our endeavor is, of course, to bring it down, by about 10 to 12 days, on an overall basis.
Well, it's been a pleasure talking to you, sir. You've given us a fair idea about the business. Wishing you all the best. And we are at CNBC-TV18 will be looking to speak to you on the date of listing as well. All the best and have a good day ahead.
Thank you for having me. Thanks.
All right. On that note, though, we'll wrap up on this edition of Chartbusters. Mangalam's won red. The market's in the red. Let's see if the fortunes change, because Mangalam stays on TH, but I move out. Stay tuned. The team of Trading Hour comes up next.